If you're like me, you wish that there's some cheat code that you can use to finally make some money in the stock market instead of, well, losing it. While unfortunately there's no cheat code for gains, there's perhaps one to avoid losses. A lot of people have made these types of videos, but I believe that they're missing the bigger picture. Obviously some losses will be inevitable, but a lot of them are caused by 7 simple misconceptions that people have about the stock market that can very easily be avoided. I'll show you what these fallacies are, how to avoid them, and what you should do instead. Each one is more important than the last, so make sure you stick around. Fallacy 1. The endowment effect. The endowment effect is an irrational bias towards things that you own, or in this case, stocks that you bought. Let's say you're holding a stock that's 10% down. A lot of people will refuse to sell and keep on holding, hoping that they'll eventually recoup their losses and break even. While this isn't a terrible idea in principle, most of the time you're probably just better off cutting your losses early. The stock may end up taking a very long time to recover, if ever, and your money could be better spent elsewhere. As the great investor Peter Lynch once said, some people automatically sell the winners and hold on to the losers, which is about as sensible as pulling up the flowers and watering the weeds. However, if you're up by an equivalent amount, you probably won't sell until it potentially erases all its gains. Cut your losses early and let your winners run. One easy way you can do this is with the trailing stop loss, where your shares are automatically sold if it drops a set amount from the current price. Fallacy 2. False extrapolation. This stock did very well recently, so its performance will continue. I'm sure you've seen the phrase past performance as not indicative of future results a ton in the context of the stock market, but most of you, including me, probably just assumed that this is a disclaimer so they didn't get sued into oblivion when you lost all of your money following their advice. While recent bullish movement in a stock can be indicative of the company now doing well, it could just be a short-term shift in sentiment. Remember, most stuff that happens in the stock market doesn't have a clear, discernible cause and is just due to random fluctuations. Don't try to read too deep into price action. Fallacy 3. Not being subscribed to Omni Capital. If you're enjoying this video, which I think you are given you made it this far, please consider liking and subscribing to boost this video in the coolies of algorithm. I'll truly appreciate it. Now onto the real Fallacy 3. Fallacy 3. Overlooking efficiency. The principle of efficiency is genuinely one of the most important concepts that you need to understand. Put simply, the efficient market hypothesis claims that all available information is already accounted for and factored into the share price, meaning that it's impossible to consistently make profits based on certain information that you now know. If everyone else knows it, then it will already be priced in. Here's an example. Apple's about to release a new iPhone, meaning that they're about to make a lot of money, meaning that the stock price is about to go up, right? However, since the fact that they're releasing a new phone with public information, that expectation is already factored into the share price. Oftentimes, you'll see that the stock price actually goes down after the Apple event. That one was pretty obvious, but let's take another example that's more long-term. People say that AI stocks, such as Nvidia, are going to do great over the next decade because AI itself will develop and expand hugely. What they're failing to realize is the fact that the reason why Nvidia has done so well over the past 18 months or so is because investors have already priced in those expectations. This is how bubbles develop. The principle of efficiency is why consistently making winning trades is so hard. Sure, do all the analysis you want, but most of the time, all information they could potentially find to give you an edge is already considered. You will never be better than everyone else when it comes to having an advantage of information in the market. One important thing that I will point out, just for the sake of being thorough, is the fact that the markets aren't perfectly efficient by definition. They're also swayed by investor sentiment. The reason why I can say that with confidence is way too complicated to fit in this video, but if you guys are interested in a full video about efficiency, then please let me know in the comments. Therefore, the thing that you actually need to do to make money is find a stock with a gap between its perceived value and its true value. Easier said than done though. Also, if you want to help recoup some of your losses, you can get a free $250 by signing up for the referral bonus on M1 Finance using the link in the description. Now on to the 4th mistake. Fallacy 4. The vicious cycle. Over the long term, there's a very real effect that makes you much more likely to lose money, known as revenge trading. As soon as you lose one, you'll feel inclined to take on more risks to make it back, which will probably lead to you losing more. Let's say you're a new trader with $10,000. You, being a risk taker, want to buy something with the potential of making you a lot of money. Options check that box, so you buy them and proceed to lose. Now you have $9,000. No problem, you're just one winning option trade away from breaking even. So you risk even more, and now you have $7,500. Now you're miles away from breaking even, and now you need to make even more risk. Now you have $5,000. Rinse and repeat until all your money's gone. So how do you escape this vicious cycle? Don't feel inclined to risk more than you would normally. You're always better off making incremental gains than trying to hope for one big one. Fallacy 5. Listening to your heart. Investing is one of those things in life that you need to be completely rational about. After all, it's your money that's on the line. Because of this, letting your emotions get involved can be very dangerous. Think about a phenomenon such as FOMO. Everyone on Wall Street bets is saying this new meme stock is about to rocket and you should buy in. You don't want to miss out on this opportunity, so you dump your life savings into it without even thinking about it. You absolutely need to conduct your due diligence and make sure it's a somewhat decent investment. This also has to do with the aforementioned vicious cycle. You feel angry and frustrated when losing money. If instead you look at it from a rational point of view, you won't feel the need to take on more risk. You need to have a calm state of mind and a healthy mindset. Additionally, you can make this less of a problem by actually restricting the amount of money you trade with. You won't be as invested in your investments and you'll feel more secure about your securities. And this ties perfectly into our next fallacy. Fallacy 6. Overtrading. Overtrading can take shape in one of two ways. You either trade too much or trade with too much money. I get it, you want to take advantage of every single opportunity and don't want to miss any potential winners. But trying to stay on top of everything and constantly trade can and will lead to disaster if you aren't fully doing your due diligence or waiting for the perfect opportunity to enter. This can lead to you straying away from your trading plan and pretty much just pressing buy and sell buttons randomly, hoping for a winning trade. You need to have a strict criteria as to when you enter and exit a trade, and don't just buy a stock on a whim. Also, there's no problem with just taking a break from the market for a couple of days, just remember that. You could also be potentially trading with too much. Position sizing is huge. I made this quick simulation to showcase my point. Let's say every trade is a coin flip, which is pretty generous considering most people lose money more than they gain money. A win or a loss will be defined as 10%. If you risk 20% of your account for each trade, you'll be in the red 85% of the time over a long period of time. However, if you only risk 2% of your account for each trade, you would now only be in the red 54% of the time, a significantly better outcome. You'll also not be as worried about your position if there's less at stake. Fallacy 7. Doing this in the first place. Instead of being an active investor at all, why not take a step back and just buy some good old index funds? Statistically, you're going to be so much better off just letting your money grow over the long term than to worry about trying to chase it for the short term, because it probably won't work out very well for you. If someone had a foolproof way to make money trading, they would not be telling you about it online. Maybe put the majority of your funds in some securities that are actually secure, then do whatever your heart desires with the rest. If you want to see what could happen to people who don't avoid these fallacies, click this Wall Street Bets Lost video. Remember to like and subscribe, and thanks for watching.